Apollo works at Dimensional Fund Advisors, which is one of the premier investing companies in the world, who have been quite successful. I'm going to borrow some of your words, Apollo, from a different podcast. They've been quite successful at cross-fertilizing academic and scientific research with actual investing. So we've got Apollo Lupescu. Very excited to have you on. He's the vice president of Dimensional Fund Advisors, one of the premier investment managers in the world, managing around $650 billion in assets. He is a nationally and internationally recognized speaker who has delivered hundreds of lectures and seminars to financial professionals and individuals, investors on various investment topics. Apollo is considered the secretary of explaining stuff. We may give you a different call sign, but that's a good one. He's got a knack for explaining complicated issues in a clear and understandable way. He's been with Dimensional in Santa Monica for over 18 years. I'm a little jealous about that, although Colorado's not bad. Prior to that, he taught at the University of California. He received his PhD in economics and finance from UC Santa Barbara. He also holds a Bachelor of Arts in economics from Michigan State University, where you also played water polo. I mean, you're really living up to the Apollo name, Apollo.
Yeah. Well, hi, Rob. Hi, Charlie. I did, and I still play. But what was interesting is that years ago, 1995, I actually did visit Colorado Springs at the Air Force Academy, where they had something called the Olympic Festival, which was a gathering of the sort of top athletes. And I got to be there in your neck of the woods, and I loved it. It was beautiful, and that facility is just stunning. But it is harder to do anything out there because the air is rare, as they put it out there.
Oh, that's fantastic. I love it. And of course, Apollo, you know, we're pilots, so we give honored guests call signs. And right off the bat, you have an amazing name. I'm not usually jealous of names, but I am jealous of yours. Apollo obviously stands for, and what this reminded me of is my Greek mythology serves me here. He's the sun god in Greek mythology. Right. And it reminded me of my Air Force days. They used to call us zipper-suited sun gods as pilots, which wasn't always an affectionate name, but that's what they called us nonetheless. Yours is affectionate. So I thought maybe we'd give you a call sign. You're looking pretty nice in your suit there. Maybe tailor-suited sun god, something like that. Try that on for size. Was that? Does that sound good to you?
Which part is the call sign? The zipper?
The tailor-suited sun god.
Tailor-suited sun
quite
god.
lengthy.
Yeah, we gotta shorten it down a little bit. We'll figure that out during the show or something.
Well, I'd love to get a call name from you guys, from pilots. That's pretty remarkable. So I never got that before. So thank you for giving me one.
We thought maybe Apollo 13. I've got my Apollo 13 mug here. Failure is not an option. Maybe Jim Lovell, something of that ilk.
That's right.
Yeah, thanks for playing.
Well, I gotta tell you, if my wife's name was Creed, I might have taken her last name just for picture.
Oh, that's awesome. Too cool.
Oh, fantastic. Charlie, you got anything you want to throw in here?
We're just excited today, and Dimensional is a great partner for us. And I always say that Dimensional, and specifically Apollo, and even Carson, our representative there, are like the big brains in the room. You know, when we have questions, we get to refer to them and their vast, experience and knowledge. So I think the title is awesome, Secretary of Explaining Stuff, because it's super difficult to take some concepts and break them down into simple ways. That's hard. That's really hard to do. I can take simple things and explain them simply, but not complex things. And that's what Apollo, you're great at. And I specifically remember and appreciate your videos during COVID, because you all started really cranking out the messaging during that battle. And it was huge for us to rely and to tune in to what you were saying, because we were scrambling at that time trying to figure out how to message these things to our clients. And we relied on you specifically, and Dimensional as well, a lot. And it was just tremendously valuable and helpful.
Well, thank you for nice words and for the trust in the partnership. And those are crazy times. Mm-hmm. We're talking about is like it's a previous lifetime. And in fact, it was 2 years ago. I mean, how much has happened over the past, couple of years? And you're right, when we are in the middle of something that is more tense and that creates anxiety, I think it's kind of natural. It's our human nature to pay attention more to things that can hurt us, because that's what helped us survive. I mean, there's an animal, you're afraid, you run, and that saves your life. And I think fear is a fundamental premise of our human condition. It's just a question when it comes to investing, how does it manifest, and is that in your best interest? And I think a lot of times the way I look at it, guys, the advisors are there, throughout the year. And most often I find I earn my keep and the advisors earn their keep when there is a situation, when there's something that's not going right. And the closest analogy that I thought is I have a very, very good friend that I swim with in the ocean, and he chose to be a firefighter. And he comes and he tells us that he goes to the station, and every morning they make breakfast together, and they clean up and they train and they work out, and it sounded like the best life ever. And I thought, this is amazing. And what happened was, when there's a fire up in the woods not far from where I live, those guys were called and they ran into the burning fire and they saved people's lives. And in a way that clicked with what you do, because quite often you prepare yourself for times like COVID, times when the markets are down, times when there's craziness, because that's when you can really save somebody's financial life. And I think that's to me, you are a bit of like firefighters, not just pilots. So I always thought that crazy times are when we earn our keep.
Yeah, absolutely. It's awesome. And Rob, I'll just kind of frame today's discussion around what there's some myths that we want to address, or Apollo, have you address for us. And we've kind of picked out 5. We may not get to all 5. We may concentrate on a couple of those because they're very interesting. And I bet a couple of those are carryovers from what we've went through in COVID. We're still dealing with some of those, the hangover, so to speak.
Absolutely.
But the first myth that we want to address is probably the most common one that we all deal with. And we all have this inclination to want to time the market. So a lot of the questions we get sometimes go like this. Clearly the stock market is going down, and clearly it's going to get worse. Why not just go to cash now, wait this thing out, after the recession clears, we'll get back in the market. Apollo, that's something we have to think about and talk about a lot. How do you address that myth, specifically?
Yeah, and it's so in a way understandable, because I have to say, everybody, myself included, everybody works hard to set some money aside, and you save this money and you invest it because you want it to grow. And it's really hard to think that I could lose some of that money. So people thinking that somehow is a good idea to avoid the market downturns and not take those losses. I think, again, it's understandable. And in fact, Robin and Charlie, I actually had the exact same thought when I started my PhD program, and I started looking at numbers and having data sets and having really good professors. And my idea was that there are times when it's so obvious that the markets are not really going in the right direction and you ought to get out. You want to just move out of the way and then come back at a later time. So the idea that it's intuitively appealing. So in that respect, I totally get it, that's how many people define successful investing. And what I found, being in the industry for all these years, is that in fact, even as it is intuitively appealing, the execution of that strategy is when you run into trouble. So it's not that the idea is not good, it's just that how do you execute it? And I'll give you some of the issues that I faced myself, and I've seen over the years many other people dealing with. The first problem that I found is that invariably I could tell myself, maybe the market's too high, or I look at valuations and they're too high. So I make the decision that I want to sell. The trouble is that when you make the decision to sell, you also have to think, am I going to be out of the market forever and ever and ever? And most often the answer is no. Of course, at some point I want to come back, as you said. So then what you have to think is that not only do I have to know when to get out, but there's an equally important decision that I have to make at exactly the same time. When do I get back in the market? And that's the issue, is not making one correct decisions, but making 2 correct decisions at the same time. Because if you don't make the second decision on when to get back in, what I found with my own personal experience is that the stress of being in the market is very quickly replaced by the stress of being out of the market. Because at that point you see the market going up and you can wonder, well, when do I get back in? Particularly if you already took a loss, it's like, I'm not even recovering my losses and the market's going up. What do I do? And I've met so many people who during the pandemic, during 0809, during, all these times when the market drops, they might sell and perhaps they might avoid some of the downturn, not all of it, but some of it. The trouble is that invariably the question that I get is like, when do I get back? And by then the market's actually higher than when they sold. And by then, obviously they have a loss, a net loss. So to me, the first thing to consider is not only that you need to know when to get out, but it's an equally important decision to know when to get back in the market. The second thing that is important to know is that the reason for suggesting not to get in and out of the market is really has to do with trying to understand the nature of the stock markets. And everybody's been trying to predict the stock markets for a very, very long time. And the reality is that it's really not possible. We know that the nature of the market is to fluctuate in value. That's just, we know that's the case, because if you look historically, the market's never been steadily going up. The stock market's always been, kind of fluctuating. So, there are times when it goes up and times when it goes down. And we call these times bull markets and bear markets. And the popular definition is that when the market goes up by, but goes down by more than 20%, we call that a bear market. Otherwise, it's a bull market. So what do we see there when you actually look at the data going back to the 1920s, since we have good data in the S&P 500, which is a good metric of the U.S. market? What we see is that the nature of the market over this entire period is to have times when it drops. What you see back in the 1930s, there were significant times when the market dropped. There are quite a few periods when the market dropped in this bear territory. But what you see is also that the bear markets, which are the ones in yellow, they don't tend to last terribly long. The shortest bear market that we had was in 2020 during the pandemic, and that lasted a single month. We had a bear market for a single month. We had a bear market this year for a short time, and then it turned into a bull market. And then, you see here it's 2 months or 13 months. So it's not exceedingly long, especially when you compare to the length of a bull market. The bull markets tend to last a lot longer than bear markets. And the idea here being that we know that the nature of the market is to fluctuate in value. We know that's the case. Trouble is that it's not in a predictable fashion. So the second reason I'd say, it's not necessarily a good idea to get in and out of the market beyond the fact that you have to make two correct decisions. The second one is that we know the nature of the market is to fluctuate. We know at some point there'll be a downturn, the same way that we know that here in Los Angeles, one day there'll be an earthquake. Mm-hmm. The knowledge of the earthquake or the market going down is not really useful unless you know when. Mm-hmm. And if you look historically, there's not a pattern that tells you that what's going to happen. From month to month, the market is pretty random. So that's the second reason that I would say. The third reason is that we want to look at data and evidence. And whenever we look at data, I wanted to know, in my own experience, why is it that I would consistently fall behind a stay invested strategy if I moved in and out? Because again, I was earning a PhD. I thought I was pretty smart, which I'm average. I'm not any better or any dumber. But I wanted to understand, why is it that I would consistently just fall behind? And what I found is that the nature of the market is quite interesting. Maybe I'll ask you folks, because I've been talking for a while. If you look at the S&P 500 on a daily basis, what split do you think is in between good days when the market goes up versus bad days when it goes down? What's the positive, negative, the good days, bad days in the market, roughly speaking, over the past 2 years, 5 years, 10 years, whatever, over the long run?
I'll take a guess, Rob, and I guess the good days are 52% and the bad days are 48%.
Yeah. I'm going to go 51-49, Apollo.
Wow, you guys are almost spot on. You just missed it by one the other way. It's actually 53% roughly of all trading days are positive, and about 47 negative. But, depending on the time period, it could be 52, it could be. But the idea is that on a daily basis, it's pretty much a flip of a coin. You can't really tell, is the market going to go up or down? It's just not really possible to tell. Just the nature, that's just, you can't really tell. Now, the thing is that if you now switch the time horizon, because most people don't get in out of the market daily, hopefully, because that costs a lot of money. But you do it monthly, and now you're asked the same question. If you look historically in the S&P 500 on a monthly basis, what's the split between positive months and negative months?
I think it's a little higher, 66, maybe 2/3 versus 1/3 possibly.
I'm going 67 this time.
Actually, you're a little bit the other way now. It's roughly about 63. So not far from where you're. It's pretty much spot on. But what you're doing is you're improving your odds. If you simply don't look at the market daily, but you actually look at it monthly, instead of 53 is roughly about 63% of the time the market goes up any given month. And here's a way to think about this. If you get out of the market, then it's possible that you miss a bad month and you pat yourself on the back and say, great, I saved myself some money. The reality, though, is that if you end up being out of the market, it's possible that you miss a bad month, but what is it more likely for you to miss, a good month or a bad month?
Right.
And you have a better chance of missing a good month. And again, what happens in the market from one month to another, it's completely random. So getting out of the market would be like going and playing a game where 63% of the time you stand to lose. Why would anybody do that? So to me, ultimately, it's another reason that staying invested is better. And the last reason that I'll give you, again, from my own personal experience, when I sold, thinking that I can't take this, a lot of it was emotional. But when I sold, one surprise that I got was from my accountant, because he called me up and he said, well, when you sold, you had appreciated positions. So now you have to pay taxes on some of the gains. So when I got to reinvest, I didn't get to reinvest the full amount. I got to reinvest the amount that I sold minus the taxes that I voluntarily chose to pay to the government. So be careful, because when you sell and you have appreciated positions, you're not going to be able to reinvest the same amount of money. It's going to be less. And because of all these reasons, that intuition that seems so appealing, let's get out of the market, come back in. I wish it was possible to do it. In my experience, nobody has been able to consistently make these two correct decisions. Nobody's been able to actually defeat the odds. And nobody has been able to predict the fluctuations, the ups and downs in the market, and for good reasons. Listen, folks, the reason that the market's going down quite often is because of unforeseen events, things that you could not see. If you were in November of 2019 and everything looked pretty good, how many people would have guessed that a month later, randomly, a virus will emerge and create a pandemic in the world? It's if you're trying to say I can predict that specifically, it's just silly. You don't need that. That's the good news. You don't need any of that to be a successful investor.
And even if you would have predicted that, then like you said earlier, then you got to find the right time to get back in, which
exactly right.
So even if you knew what was happening, you'd probably be wrong.
Yeah. And there's a great study that looked at the cash flows and how much investors sold as the market tanked. And then as the market recovered, they were still in cash. They never got back in the market. And for those people, those losses might have become permanent instead of a paper temporary loss if you just stayed invested.
Yeah, absolutely. And, one of the things I remember, Apollo, from, again, when you were giving your speeches almost weekly in March of 2020, the thing that stuck out to me the most powerful at that moment was when you leave the market or go to cash, you're simply replacing one stress with another.
Yep.
Because that's really what it was forget about all the math and statistics. It was just very stressful for people, very scary, but you really just replaced one for the other. Because Rob, in fact, you and I did a video right when you were brand new at Leading Edge during that time. And we said, we showed the graph of all of 2020 and said, when was a good time to get back in? It was, the news headlines anyway, for that whole year were scary. Not to mention a little election in November of 2020, right?
Yeah, absolutely. And by the way, I mean, I'm going to bring up one other thing that it was so stressful, and quite often, whenever I had a chance to interact with individuals and their advisors, one of my first questions was, people say, I'm in retirement and I'm scared of what's going on. And my thought was like, okay, so you have a financial plan. The advisor actually helped you with a financial plan that's customized to your needs, so the question is, how much of your portfolio is invested in the stock market to begin with, and what you see on the news? And a lot of the investors like, I'm not sure. I think all my money is invested. Well, and then the advisor will, no, wait, actually about half of your money is invested in bonds, and bonds have actually been going up. So it is interesting because that not every penny is invested in the market. So when you say, I want to get out, the question is, do you want to just get out of the S&P 500? Do you want to get out of the bonds? So it's much more complicated than just a simplistic view that, oh, I'm investing in the market. The U.S. stock market might be a portion of your allocation, but there's certainly a lot of other pieces that might not move in lockstep with the U.S. stock market.
Yeah, absolutely. Rob,
Fantastic.
and I'll hand it off to you for the next one, but in the show notes, we'll have an article from JP Morgan Wealth Management, and we'll have some from DFA in there as well, but it's a great article. It's the case for always staying invested, and it talks about what it looks like when you remove money and you miss those best days or months that Apollo you were talking about, the devastating effects on your overall return. But it's just fascinating to see those numbers over and over again. But Rob, I know you've got the other myth.
Oh, I'm just this is a conversation I'd just love to be a fly on the wall for. There's a saying, if you're the smartest guy in the room, if you're the strongest guy in the room, you're in the wrong room. I'm neither. Unfortunately for Apollo, he may be both in this. So you may be in the wrong room, Apollo. But
we're not in the same room, so this doesn't apply to.
Oh,
Zoom,
good.
Perfect.
Yeah, that's good. Anybody that can play a sport while treading water is got to be it's incredible.
Geez.
But anyway,
wait, you guys are talking. You're up flying there with no oxygen and all the craziness going on, and you're looking at poor me. I'm looking up at you guys.
Oh, I love it. Hey, Charlie, I'm just going to flip the script just a little bit because we were talking about bonds and we start talking about the Feds raising rates and how that affects the market. And the question we get a lot is, so the Fed's raising rates because the economy is supposed to be strong enough to stand on its own. And then the market seems to go upside down there a little bit. What gives? Well, Apollo, can you shed some light for our listeners?
Yeah, so let's start with exactly that. So you hear so much on the news today about the Fed raising rates. What's going on with that? To understand that, we have to go back to the 1970s. And what happened in the 1970s is a bunch of things. And one of the big ones, in my view, was the fact that the U.S., up until 1971, had something called the gold standard. Meaning that if you wanted to print a dollar, if the government wanted to print a dollar, there had to be some gold in the bank. So you can always go and exchange a dollar for a certain amount of gold. And that gave people comfort that the government is not just going to print money willy-nilly. Now, in 1971, the economists and everybody realized that you can't have the system because the economy is getting bigger and bigger and bigger, and we just don't have enough gold to create all the currency that we need. So in 1971, President Nixon actually cut that link between gold and the dollar. And since 1971, we have a type of money called fiat money, which basically has value because we all believe that it has value. And that, I'm trying to go back in a time machine and see how would I have felt as a citizen of the country if I'm being told that right now the government can just turn on printing presses and there's no reason for them to stop because there's no backstop. They don't need gold. They just print as much money as they want. So there was a bit of a behavioral element that came into the society when we made that transition. And just around the time, also the Organization of Petroleum Exporting Countries, they got really upset because of our policies in the Middle East. We're not involved directly, but just to show their displeasures with our policy, these particularly OPEC countries in the Middle East, they chose not to send oil to the U.S., and we went through a big oil crisis. So when you combine these three, and there was a big food shortage because of a drought, what happened in the early 70s is that we had a really big inflation, really high inflation relative to historical standards. and that inflation reached, 10, 11% back in the early 70s. And people got used to the idea of inflation being around. And they, when they negotiated contracts, the union negotiated contracts, well, they would bake in a pretty big increase from year to year because they thought that inflation is resilient and is here with us to stay. And in fact, it did last all the way into the late 70s and early 80s because of that behavioral element, because that people did not believe that the Federal Reserve is really committed to fighting inflation, and they were not. And in 1979 or so, a new chairman came at the Federal Reserve. His name was Paul Volcker, and he actually really kind of made the very strong decisions that we need to fight inflation, whatever it takes. So he started to raise interest rates. And the idea is that when you raise interest rates, it becomes more expensive for companies to buy things, and they don't produce as much. The housing market might take a hit. Borrowers are finding that it's more expensive to borrow, and they don't borrow as much, us as consumers. So what it does, it starts to slow down the economy because purchases are being reduced by consumers, by businesses. And because of that, there's not as much pressure on the production in the U.S., and that starts to slow down inflation. So the reason that you're hearing so much about the Fed today is a lesson that we learned back in the 70s, that the Fed has to be really committed to fighting inflation. And the way that you fight inflation is by increasing interest rates, which makes companies and consumers less likely to spend money. And when that happens, then you start reducing inflation. Inflation starts getting under control. That's exactly what happened in the early 80s. And a lot of folks were concerned because if you do this, when you do this, if the economy slows down enough, well, we might run into the other issue, which is a recession, that we might not have enough production out there because people are not buying enough or businesses aren't buying enough. So that's where the concern comes from, is the fact that the Fed today has been very clear that they're committed to fighting inflation the same way that the Fed was in the late 70s, early 80s. Which again, it proved to be a very good decision, a little pain in the short run, quite a bit of pain actually in the short run, but eventually it was tremendously beneficial because ever since then, behavioral people knew that Fed is committed. So we're not going to really worry that much about inflation because Fed is committed to keeping it low. And that's what the Fed is trying to do today, is really trying to raise the rates, slow down purchases, and keep inflation under control. And it's trying to do it in a way that's called soft landing, meaning that the economy might not produce as much, but it won't enter a recession. The question for an investor, so with that background, the question for an investor is, well, what does it mean to the stock market when the Fed is raising the interest rate? And to do that, just to kind of clarify one thing, when we're talking about the Fed raising interest rates, in fact, the Fed only controls one interest rate, a single interest rate. They don't control mortgage rate. They control a sort of a baseline interest rate called the federal funds rate. That's the one that they can impact directly. So we can look at that particular interest rate going back, let's say, this century, and try to see if there are any lessons or case studies that we can examine. So if you go back to 2000, what you see is that the beginning of the century, on 2000, the federal fund rate was very high. It was around 7% or 6.5%, 7%, so quite high. And then as we got into the tech bust and we had the attacks in 9/11, it basically started going down and down and down, and around in 2004 it started to go up again. So here is a case where you have 3 years between 2004 and 2006 of back-to-back years in which the Fed increased this interest rate. At the time, it was to cool off the economy so we don't run into inflation. But now you have a good case study. Look, we have 3 years when the interest rate was on the rise, so we can examine that. And then what you see afterwards is that when we had the financial crisis, the interest rates went down, and in fact, they went down incredibly low, close to zero, for many, many, many years, and they stayed low, pretty much like the same way we are today. But what happened was, well, we were up until about a few months ago. And then we have another 3-year period between 2016 and 2018, when once again, there's a period of rising rates. Over 3 years, back to back to back, we see this increase in interest rates. So to me, it's a very interesting question now. So we have 2 case studies to look at as investors and try to figure out, how does the stock market react to these increases in interest rate, which is likely what we're going to see this time around, maybe more than a quarter or two of increases in rates. What is the market? What is the market's reaction to that? So let's take the first period, the 04 to 06, and look at year by year how the S&P 500, the measure of the U.S. market, did. In 2004, as the Fed was starting to raise the rates, the S&P was actually up 10.9%. In 2005, it was up about 4.9%. And in 06, 15.8. So even though we had 3 years of back-to-back-to-back increases in the Fed fund rate, in every single year, the market went up. So, when you look at this, it's kind of hard to make a case that, increase in interest rates should necessarily be bad for the market, because that's kind of what the conventional wisdom is. It becomes more expensive for companies to borrow. They had a very low cost of capital. Now it's going to go up. That's not going to be good for the market. That's not what the data shows. Now, what about the second period when you go to 16 to 18? 2016, the market's up about 12%. And just to put some context, long-term average is about 10%. So this was above long-term average. In 2017, 21.8% as the rates were going up. And in 2018, down 4.4%. So we do have a negative year here. But ultimately, when you look at this data, I'm hard pressed to find the evidence that suggests that conventional wisdom in the media, that rates are going up, it's going to be terrible for the stock market. What the data is suggesting is that if you look at the 2 case studies over the past 20 plus years, there was a year when the market did drop, but 5 out of the 6 years, the market did not drop. So why might that be the case? How do you think about this? What's the intuition behind it? And to me, the big thing is this: when you look at the stock market is about getting ownership in companies. And the value of the ownership depends on the profits that the company expects to make. And we'll come back to this because it's a crucial concept. And if you think in terms of the value of a company being of Apple, Google, Facebook, you name it, Coca-Cola being tied to the profits that they make, the question is the federal funds rate a primary variable that you can link directly, that the profits are tied directly into what that interest rate does? And what this data seems to suggest is that, there's probably, it's actually quite likely that the Fed fund rate does have some impact on the profits of a company, but it doesn't seem to be a primary connection there that you say, okay, I can, link and say, if interest rates go up, profits go down. Not necessarily. In fact, what it shows is that it's probably one of the many variables that impacts the market, but it doesn't appear to be one that you can directly link. So because of that, when this Fed fund rate happens, keep in mind that the markets know about this. The Fed's been telling the markets, and because the markets are so sophisticated, they already incorporated the expectations of increases in rates. But even if you look at times when you have back-to-back-to-back years of increase in rate, it does not necessarily spell doom and gloom for the market.
I understand why they call you the Secretary of Explaining Stuff. So that's awesome.
It's fascinating to me how it seems like there's so much psychology involved. Like you mentioned, the confidence of the Fed to have the discipline to continue to tamp down inflation, because that's super important. And then the psychology of the short-term market, when it reacts, it's almost like a sugar high when interest rates go down. But like you've shown, the markets tend to go up during those periods. And again, that's not predictive, but again, it's not a negative thing about the companies. And I love 2 things. The psychology of this stuff is short term, sometimes noise a little bit, but if we continue to focus, like you said, on the companies that we own as investors and the profits that they make, we can be successful investors.
It also, kind of back to your first answer too, Apollo, markets go up, bear markets happen, bull markets
Yeah.
happen, recessions happen, interest rates rise, interest rates fall. And, just knowing that those happen, educating our clients and investors about these things happen. It's not necessarily something new this time.
Mhm.
Yep.
Yeah. The myths that we have today to address, I'm looking at them now. I'm excited to get, it's like, I want to address all these, but for time purposes, I want to really stoke the fire a little bit, Apollo, and talk about politics and investing. So, so we
You
get a
skipped
lot.
ahead.
So the question that we get is, if so-and-so were president, if so-and-so were in Congress, if such party this or that, then it would be so much better. So Apollo, I know we've reviewed your data. And I remember in Charlotte a few months ago, you said, tell your clients you've reviewed the data. And we've reviewed what Dimensional has put out, and it's fascinating. So can you help us to frame this conversation, explain what the facts really are behind this politics and stock market?
Yeah, and it's it's the gift that keeps on giving. We have another election coming up shortly, so I'm sure a lot of folks will be curious to understand, hey, what's going on? What should I expect with that election coming up? So to begin with, let me start with just a broad comment. When when I think of politics, it is to me something that is deeply personal because it is emotional. It touches on my core identity as an individual, on my beliefs, and it just because of that, it has that tremendous impact on me. So I have to say, I think it's natural, it's human to have that emotion, and to some degree, it's desirable because politics does touch on a lot of things that have to do much more with beliefs than anything else. And it's important to have beliefs in life, and because of that, I'm a big fan of people paying attention to politics, not just because of how it impacts them personally, but because of just being good citizens and making sure that the world is going in a direction that they'd like to see it going. So I'm a big believer in democracy and politics. What I found is that quite often people try to tie the politics, which has a deep emotional side, with some aspect of their money or the economy and so forth. So it's almost the economy and the markets become of an extension of that emotional piece that they have coming from politics. And what I've learned over the years, and I think it's really important to acknowledge people's emotions and realities, because that's real to them. And I'm not here to tell you that your way of thinking is better or worse than mine. We all have our own point of view. We all have our own emotions around politics. And again, it's important to acknowledge those. What I also found is that investment managers, particularly really good investment advisors and investment managers, they acknowledge these emotions. And at the same time, when they make decisions about money, they're based much more on data and evidence, and they're much more pragmatic. And they're not driven by emotion, because that might not always be the most productive way to do it. So the big lesson that I want to start with is that I acknowledge the emotional side of investing. What I want to tell you is that us as investment managers, we want to acknowledge those, but the decisions that we make have to be driven by data. So in that respect, I'll start with just a quick overview of different presidents and how the market did during their term. So we want to see, is there evidence to suggest that being of one party or another is better or worse for the markets? That to me, it's a pretty decent place to start. So when you go back in my lifetime, I'm born in 1969. What you see is that President Nixon was in office when I came along. And during the 5 years or so that he was in office, the market on average, annualized, it went up. The S&P 500 actually went down by 2.9%. Again, the long-term average in the market's about 10%. So, it didn't seem like that was great. But then President Ford came along for 2 or 3 years or so, and the market actually skyrocketed at 20% per year during the time that he was in office. And then if you fast forward and you look at different presidents and the average annualized return per year during their time in office, the question is there an obvious pattern they would tell you that having a Republican or a Democrat is better or worse for the markets. Again, not talking at all about in their policies and their social, just looking at the data. Is there evidence to suggest? And in fact, when you look at it, it's not really clear. It's not really clear that having one president or another is better or worse for the markets. And in fact, what I found remarkably interesting is that you have President George W. Bush, who was extremely business friendly and cut taxes specifically on investments. And yet during the 8 years that he was in office, the market dropped. Well, should he be blamed for that? And my answer is absolutely not. Because 9/11 happened just as he came in the office, and then all the nuttiness, and then ended up with the financial crisis that he had nothing to do. It's just like there was way longer into the making. So and by the way, we also had the tech bust. Just as you walked in the office, the tech market, the market crashed because of what happened years and years into making. So to me, it's hard to say that having a Republican or Democrat, it makes it obvious. In fact, even if you take presidents that have different reputations, you take a president that is really considered to be, tax cutting and all this stuff, and you look and say, well, that's the legacy of President Reagan, and President Obama typically is associated with the healthcare and ACA and Obamacare. And what's remarkable is that for the 8 years they were in office, the two annualized returns are pretty much identical. So because of that, again, I go back to this idea that it doesn't appear to me that this is something that it's obviously good or bad for the market. Now, what about Congress? When you look at Congress, interestingly enough, going back to the 1920s, what you see is that the blue periods, which are Democratic, and the red being Republican, they alternate. But it seems like it's not, again, obvious to say having a Republican or a Democrat or mixed is better or worse for the markets. The trend has been up, irrespective if we have Republicans or Democrats. But to me, the one way that I really try to kind of put all together is came about a year and a half ago, almost 2 years ago, when there was a special election in Georgia, and the 2 Senate seats went to the Democrats. And at the time, since then, the Democrats had this what's called unified government control. Unified not because they're kind of holding hands and being all happy together, but because they controlled the White House, the Senate, and the House. And that became an interesting question for me. Okay, the Democrats have this. If you look at periods when the parties had this unified government control, how different are the market returns, and can you infer something from that? And I looked at the Republicans first, and I asked the question, going back to 1926, since we have good data in the S&P 500, do you think that the Republicans controlled the White House, the Senate, and the House at the same time? What do you think?
Gosh, that's a tough one.
Oh, yeah.
Not much.
I'm putting on the spot right now. I didn't know myself. So.
I have no idea.
I'm going to say 10%. 10% of the time.
10% of the time. You're close. It's actually a little bit more than 10%. It's about 13 years that they controlled the White House, the Senate, and the House. And we wanted to know, on average, during these 13 years, a simple average, on average, how did the market do during these years of unified government controlled by the Republicans? And what we found is that on average, the market went up by 14.52%. So that was sort of the average return during the Republicans. And the question is, well, now the Democrats, did they have the same unified government control? Again, another trivia question. Do you think they had it for longer or shorter?
Longer.
Longer. You're absolutely right. Yeah. Instead of 13 years, it was 34 years that they controlled the White House, the Senate, and the White House at the same time. And we wanted to know, on average, how did the market do during the unified Democratic government control? And we ran these numbers over and over and over again. And what we came up with is that on average, during these 34 years of Democratic government control, the market went up by 14.52%. It is identical to the second decimal.
Wow.
To the second decimal. Huh. So the reason I'm bringing this up is that it kind of comes back to the same notion that we made with the Fed. We talked about the Fed. there's no question that some companies and maybe a lot of companies are impacted by the government policies in Washington, D.C. But if you think of Facebook or Coca-Cola or McDonald's or Amazon, what is it more likely to impact their profits? Their services, their products, their strategy, how they execute it, what the competitors do, or who's in the White House, what the party in control in Washington is, what makes the bigger difference? And to me, it comes back to the same thing, that politics is one of the many, 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 many variables that impacts the market, but it doesn't appear to be one that it can directly link. The market does better or worse during one party or another. So again, I'm not here to make anybody feel good or bad about their political views. All I'm trying to tell you is that when you look at the data, not emotionally, but look at the data, it doesn't appear that politics has a very strong relation to, in particular, the party in control has a strong relation to the market and whether the market does well or not. There are so many other variables that drive it, and this is not one of them.
Yeah. Paulo, I just want to say I'm so glad those numbers were equal.
I know.
we would have had some questions to answer. But it's so fascinating to me that, and this is what we love about Dimensional and the way we invest as a firm, is that what does the evidence tell us? You know, and like you said, strip away some of the emotion, because sometimes it gets very confusing, and strip away the emotion, look at the evidence. What does it tell us? We know too that behaviorally as investors and as human beings, we always look for patterns. Right? Yes. It's just our bias is to find patterns. Our brain does that to make us more efficient thinkers, but sometimes there are no patterns, and we want there to be patterns based on our belief systems. So it's pretty fascinating. The last thing I'll say, Rob, before you take the next one, is that there's a lot of countries that have very different governments than us, socialist countries, whatever, and they have very successful companies within those countries, very profitable, right? That we invest in and that we are part owners in. And so I don't know if that's a great lesson here, but to me, it helps a little bit just think about how to separate the politics and the company's profits, as you mentioned.
You're absolutely right. And a lot of times the companies in which we invest might not even be based in the US. And even U.S. companies, like, you take brands like Jeep and Chrysler, to your point, those are great American companies. Well, they're not, as an investor, you don't really buy them in the U.S. They're actually traded in Italy, in Milan, under Stellantis. Budweiser, it's traded abroad. I mean, there's so many examples of these. 7-Eleven, all American, chain is actually a Japanese stock. So it's the brand is owned by a Japanese stock. So it is interesting, exactly to your point, that you also want to just keep a global perspective, because we've been talking so much about the US, but investing today is very different than it was maybe 50 years ago.
I'm going to switch gears just a little bit, just because I think we've hit economy, markets, Fed rates. I love all of that. I wanted to talk a little bit, and we've hit on it a little bit for sure, is Dimensional's difference in their approach to investing, which is a little bit different than a lot of folks, but the scientific and academic research and how that's applied to actual investing, specifically indexing, and how you guys approach index funds and at certain airlines and certain mutual funds, and they try to track those indexes very closely. And I know you guys have a different take on that. So,
yep. So let's demystify that, because it is actually really interesting. Because ultimately, what does it mean to me? How do I invest? How should I invest my money right now? And if you look a bit of the evolution of investing, because Dimensional didn't just emerge out of nowhere. It was an evolution that everything in life changes. I was walking with my son not too long ago. He's in college at Boulder, by the way. And we walked down the street, and he was saying that, Dad, when I was a really young kid, about 20 years ago, there was a Blockbuster Video that was on the corner, and he was like, "Do you remember that?" And I was like, "Yeah, you got the VHS tape, you pop in the VCR, you take it back a week later, pay the late fees, get another one." So at the time, having a Blockbuster Video and a VHS tape, that was state of the art. But the world changes. Whatever was state of the art 20 years ago, it's no longer today. So I think it's a similar evolution that's happened in investing to get us to where we are today. And maybe about 25 years ago, 30 years ago, the state of the art in investing looked something like this. If this square is the entire stock market and all the stocks fit in there, the manager's value proposition way back in the day was this idea that if you can cherry pick a handful of stocks that are just the right investments, you leave out everything else, that's going to make you a successful investor. And they charge a lot of fees for that. The fees were quite high to charge just the right companies. And again, intuitively, it's appealing. The trouble is that over the past 20 years or so, information travels so much faster. It is available to everyone, and it's gotten to be incredibly competitive. I just read just a few days ago that when you look in the U.S. At all the investment funds, there are probably twice as many professionally managed investment funds that actual stocks trading on the market. So it's incredibly competitive. And because of that, this particular way of trying to just identify the diamond in the rough, to find the one thing that nobody else has found, that everybody has missed, is like, it seems a little obsolete. And the data suggests the same way. Only a fraction of these managers actually outperform. But what emerged in the 1970s with the advent of computers and more rigorous data was a different way to think about investing. And the idea back then was that, okay, well, let's look at these companies. There might not be any reason why not to hold them, so let's consider them. But the idea was that instead of trying to understand the behavior of these companies and form an expectation about these companies by themselves, the idea was to create a different way of looking at, which are much broader parts of the market. And the idea is that as an investor, you want to understand not the stock by itself as much as the category to which it belongs. So the idea of identifying broad categories in the market, something that has become known as asset class investing. And I was trying to explain this to a family member, and the one thing that kind of helped them get it is that if you think of the stock picking, which is what the strategy on the left is, that's more like trying to look at a school of fish and trying to predict how each fish will move. But we all know it's unpredictable. It goes up, down, left, right, sideways. Every fish moves so randomly, it's hard to predict how each fish will move, which one will thrive and which one will die. But on the other hand, it's a lot easier to capture and understand the behavior of the entire school of fish with a lot more precision. And that's what really is the evolution, in my opinion, of investment management, is not trying to fish by the rod, but fish by the net, really trying to understand characteristics of asset classes and not love or hate any one stock, but really look at a bigger picture. And this, at the broadest level, this could be the entire stock market. And that's where index funds came along. So index funds, when they came along, they weren't really interested in any one stock, or they just said, let's just look at the market as a whole. And the founders of Dimensional, in fact, were the very first folks to create S&P index funds and actually introduce them to large institutional pension funds. So they certainly knew about indexing. And the thing is that indexing, in my view, is a step above stock picking. The thing is that indexing, to the point that he made earlier, you're basically, as an investment manager, as a mutual fund manager or ETF manager, whatever you are, you're licensing a list from a third-party committee, whether it's the S&P, whatever, you name it. They're all these license providers. And you create a fund called an index fund. And the mandate of that fund is to perfectly replicate the list of stocks from that third-party committee and do it into a fund. And that's called an index fund. And again, the good news is that you're buying the school of fish. It's fairly tax efficient. It's fairly low cost, and it tends to outperform a lot of times the stock pickers. So in that respect, that's why I think the index is a step above. Now, what you also find is that if you are a manager and you have no decision power over the stocks in your fund, because you don't decide, it's the index committee. And when the index makes a change, everybody who licenses the list has to make it. You're really bound, and you cannot really add any value. So to me, index is a good idea, but it's limiting by the fact that as a manager, you're licensing the list, and in your fund, you cannot do anything more than buy those stocks in the proportion that's created by the list. So what dimensional does is basically trying to say this idea of the school of fish is not bad at all. But can you actually do better than an index? And this is where we think that you can absolutely do better than the index. And the first one is you can adjust the list itself. How can you do better? You adjust the list itself. And if you think of the market again as a square, the first thing is to delineate between different parts in the market. And the first delineation we made back in the 70s was the distinction between large company stocks, which are in the S&P 500, but also some smaller companies, which are not part of the S&P. And we do have just a phenomenal book called The Matrix Book. It's one of my favorite books that we published forever. And in that, you can look at the growth of a dollar in these different asset classes. And large companies in the S&P going back to the 1920s, a single dollar invested would have grown to about $14,000. That's a pretty significant growth of a dollar in the large companies. But if you had invested the same dollar over the same time period, and you look at the Matrix Book on the dimensional US small cap index, what you see is that the same growth dollar would have been over $47,000. So a significantly greater growth in small. So what dimensional suggested way back in the day is like, it might not be anything wrong with holding the S&P, but why not paying attention to the entire school of small company fish? And that's a way that you can increase your expected returns. And then in the 80s, the question was, what about all the large and what about all the small? Are they exactly the same? And the answer was no, that you can delineate based on the price that you pay to buy a dollar of book value or earnings, whatever, cash flows. And the low companies, low price stocks are called value. And over the long run, they have outperformed the more expensive counterparts called growth. So knowing that small beats large and value beats growth, obviously the one part of the market that ought to give investors the biggest bang for the buck in the US and abroad for that matter, the same principle applies, is small value. And the same dollar invested in small value going back to the 20s from the Matrix Book, the Dimensional US Small Cap Value Index is $134,000. Wow. So the idea what Dimensional suggested is like, okay, so one way that you can increase your expected returns is not plow all the money into the large cap, the S&P, but rather if you want to emphasize some smaller company stocks, if you want to emphasize some value stocks, as an investor, you give yourself a chance to earn a higher expected return. So the way that we reshuffle the deck, we don't, buy the same percentages as the index. We try to emphasize different parts in the market. So there's just one example out of many, many examples that we can give on how you can increase the returns, the expected returns beyond what an index gives. But I don't want to knock down the index. It's not bad. Right. It's not bad. The index to me, it's a little bit like if you're flying a plane and maybe not a fighter jet, but if you fly a commercial plane, there's a computer that theoretically, from what I understand, can have the plane take off and fly and land at some other airport. And an index might not be, the computer is certainly not a bad idea. The trouble is if you're saying all I do is put the computer to fly and I don't leave anybody in the cockpit, well, that's a little problematic. What we're saying is use the computer, use this, use some of the knowledge that that you have in the computer, but also put in the cockpit a pilot so you can make some decisions. Don't just let the autopilot of an index provider do everything. You make some decisions yourself. And do it alongside with an algorithm. So anyway, so that's just in a very broad nutshell what dimensional does is really trying to go beyond indexing and have a very systematic approach in which you emphasize different parts of the market, but also you execute differently because you're not bound by replicating a list pretty mindlessly like an index does.
Nice.
Thank you for the example too. We appreciate that.
Yeah, that was good.
I was thinking like, what do I know about flying?
That's right. No, that's perfect. And Rob, we certainly changed up our agenda a little bit on Apollo. So thank you for flexing with us and taking a question that you could talk about for an hour and knocking it out in about 6 minutes. But what I love about the process that you just talked about, and this is what I tell our clients, and they say, hey, what about this company or this country? Or this or that. And I say, hey, look, if it meets the criteria that you just described, Apollo, then you're going to own it. Yep. So you kind of set this system, this process, this criteria. And if those companies meet that criteria, then they're going to own it. And that's what I love about the process. And I know we're up on our time limit, so I'm going to finish up, Rob, just by saying that the call sign for Apollo is Apollo the Oracle Lupescu. That goes along with the
Isn't
Greek.
that taken?
That's what he
I think
is.
the Oracle's taken.
The
I don't know if you
Oracle.
can use that.
And so honorary call sign. And I'm just so grateful for Apollo joining us today, and I could talk on this stuff or listen to you talk on it for forever. So, but Rob, I'll hand it back to you to finish this up.
Oh, that was fantastic. Thank you for taking the time, Apollo. And you could have so many call signs. It's ridiculous. All of them are
great. The disco ball, the crystal ball.
There you go.
Yeah, we will not stick with the Taylor suited sun god, although I am jealous of your tan. I don't have one. But I'm, out in Santa Barbara, the weather's nicer, I think, for the tanning. And you've been surfing, so how's that going, by the way?
This morning at 6. So.
Wow. Are you kidding me?
Awesome.
You go every morning?
No, but the last few days it's been better because the waves are a little bigger. So I got motivated to wake up early, and I love it. It's beautiful.
I love it. I got a buddy out in San Clemente. He takes me surfing every time I fly into.
That's the real deal. That's where the real nice surfing is.
Yeah, I'm a longboarder, so I can't. I'm not going to be on any videos or anything. All right. Well, that's it. Thank you for flying with us on Flight 41. It's been our honor to have Apollo with us today. And let's be the first to welcome you to our final destination. A couple of quotes for you to ponder as we've arrived here. This one's from Eugene Fama, of course. Active investment is a zero-sum game. Passive managers don't play the game. They buy something resembling the market as a whole or some segment of the market, and they don't respond to the actions of active managers. And the second by Merton Miller. All these are dimensional, kind of founders, if you will. So in honor of Apollo being here, everybody has some information. The function of the markets is to aggregate that information, evaluate it, and get it incorporated into the prices. That's it. As always, if you enjoyed the podcast, click the subscribe button and leave us a review so we can hopefully help more people. And remember, as Emerson said, the world makes way for those who know where they are going. So plan accordingly. From all of us at Pilot Money Guys, we wish you smooth rides and soft landings again. Thank you.
Leading Edge Financial Planning, LLC, is a registered investment advisor. Advisory services are only offered to clients or prospective clients where Leading Edge Financial Planning and its representatives are properly licensed or exempt from licensure. For additional information, please visit our website at www.leadingedgeplanning.com. The information provided is for educational and informational purposes only and does not constitute investment advice, and it should not be relied on as such. It should not be considered a solicitation to buy or an offer to sell a security. It does not take into account any investor's particular investment objectives, strategies, tax status, or investment horizon. You should consult your attorney or tax advisor. The views expressed in this commentary are subject to change based on market and other conditions. This video and audio may contain certain statements that may be deemed forward-looking statements. Please note that any such statements are not guarantees of any future performance, and actual results or developments may differ materially from those projected. Any projections, market outlooks, or estimates are based upon certain assumptions and should not be construed as indicative of actual events that will occur. All information has been obtained from sources believed to be reliable, but its accuracy is not guaranteed. There is no representation or warranty as to the current accuracy, reliability, or completeness of, nor liability for, decisions based on such information, and it should not be relied upon as such.